There's a pattern that shows up constantly in prop firm evaluations, and it isn't the one most people talk about. Most people talk about the trader who was actually doing well, who had the account in profit, who had every reason to feel good, and who still managed to give it back. Not through recklessness, through something quieter, through discomfort with winning itself. That's what this video is about. Let me say the sentence again, slower, because it's the whole video. It is possible to be uncomfortable with winning, not in some abstract self-help sense, in a very literal, very physical, sitting at your desk right now sense. And if that sounds strange, it's only strange because nobody's ever pointed a camera at it directly. Every piece of content you've probably watched about trading psychology is aimed at the losing side of the ledger. Manage your losses, control your revenge trading, don't move your stop loss. All true, all useful, and all incomplete because they leave out an entire category of self-sabotage that happens exactly when things are going right. So here's what we're going to do for the next hour. We're going to walk through why the brain treats an open winning position as a threat instead of a gain. Even though logically that makes no sense. We're going to look specifically at how this shows up inside a prop firm evaluation, where the stakes and the psychology compound each other in a very particular way. We're going to bring in the way Mark Douglas framed the probabilistic mind and apply it somewhere his own writing only gestures at the discomfort of being ahead. Not just the discomfort of being behind, we're going to walk through a composite trader, someone built from patterns you'll probably recognize, and follow one trade from entry to exit through exactly this lens. And by the end, you're not going to have a 5-step system. You're going to have something more useful than that. You're going to have the ability to notice this happening to you in real time, which if you've watched enough of these videos, you already know is most of the work. Let's start with what this actually looks like, because until you can recognize it, none of the psychology underneath it matters. You take a trade. The setup was clean. You didn't force it. Maybe it's a breakout that had proper volume behind it. Doesn't matter. The point is you didn't hesitate. You executed, and price moved in your direction almost immediately. This is the good version of a trade. This is what you say you want when you talk about your trading in the abstract, when you're not actually in one. And then something happens that almost never gets talked about the moment the trade goes green. Your relationship to it changes. It stops being a position you took because you had an edge, and it starts being a number you're afraid of losing. Watch your own behavior the next time this happens to you. You'll start moving your stop loss up. Not because price structure changed, but because you want to lock something in. You'll start glancing at the target you originally set and thinking about closing early, not because the trade weakened, but because the profit feels like it's sitting there, exposed, waiting to be taken back from you. You didn't do this when the trade was flat. You definitely didn't do this when the trade was red. When you were down, you were oddly patient, willing to wait, willing to give it room. The moment it turned in your favor, your patience evaporated. If you've traded for any real length of time, you already know this isn't hypothetical. You've lived it. You've closed winners 2 minutes before they would have hit your target, only to watch price keep running without you, and you've told yourself a story afterward about why that was actually the smart, disciplined thing to do. Sometimes it was, but if you're honest, a lot of the time it wasn't discipline. It was relief. You wanted the discomfort to stop, and closing the trade was the fastest way to make that happen. Here's a version of this that's specific to prop firm traders, and if that's you, I want you to really sit with this one. In an evaluation, every winning trade is doing 2 jobs at once. It's moving you closer to your profit target, and it's simultaneously becoming something you could lose that would set you back. Early in an evaluation, this tension is small because you don't have much profit sitting there to protect. But the closer you get to passing, the heavier this gets. A trader who is up 8% with a 10% target starts trading like someone protecting a lead in the 4th quarter. Not like someone executing a strategy. Every new trade after that point isn't really about the setup anymore. It's about not blowing what you've already built. And that shift, that quiet shift from playing to win into playing not to lose, is one of the most common ways a good evaluation turns into a failed one. Ask yourself honestly the next time you're deep into an evaluation and sitting on solid profit, whether your trade sizing has changed, whether you're taking the same setups you take on day one, or whether you've started skipping perfectly valid signals because some part of you has decided the account is now something to defend rather than something to grow. Most traders never ask themselves this question because the account being in profit feels like it should be the good scenario. Nobody warns you that profit changes your psychology just as much as loss does, sometimes more. I want you to actually think back right now to the last time you were sitting on a winning trade and felt that pull to close it early. Not a trade that hit your stop, not a trade that hit your target cleanly, a trade you closed yourself with your own hand before it got there. What did that feel like in your body? Was it relief? Was it a kind of exhale? If you can name that feeling, you're already halfway to understanding everything else in this video, because that feeling is the entire subject we're studying. So why does this happen? Why would a rational person feel more anxious holding a gain than holding a loss? The honest answer is that your brain was never built for probabilistic thinking. It was built for pattern recognition and threat avoidance in an environment where the rules were completely different from the market. Here's the underlying mechanic. Put simply, losing something you have registers psychologically is a much bigger event than gaining the same amount. This isn't a trading-specific quirk. It shows up in almost every area of human decision-making. People will work harder to avoid losing $100 than they will to gain $100, even though mathematically those are identical amounts. Your brain doesn't treat them as identical losses or louder. Losses get flagged as more urgent, more threatening, more worth acting on immediately. Now apply that to an open trade. The moment your position goes green, your brain doesn't file that profit away as a nice, stable gain that belongs to you. It files it as something new to lose. You didn't have it a moment ago, and now you have it. And the possibility of it going back to zero or worse going red registers as an active threat, the same category of threat as an actual loss. This is why the anxiety you feel watching a winning trade can sometimes feel almost identical to the anxiety of watching a losing one. Your nervous system isn't distinguishing between the two the way your logical mind wants it to. This is where the urge to close early comes from, and it's also where the urge to move your stop loss up too aggressively comes from. Both behaviors are your brain trying to convert an uncertain gain into a certain one as fast as possible, because uncertainty around something you could lose is deeply uncomfortable. Even when the odds are actually in your favor, here's the part that makes this genuinely difficult to work with. This response isn't a character flaw. It isn't a sign that you're undisciplined or weak-willed. It's a default setting inherited from an environment where instant reactions to threat kept you alive, and where sitting patiently with an ambiguous gain that might disappear was not a useful survival strategy. The market is one of the only environments in human experience that consistently rewards the opposite behavior. It rewards sitting with uncertainty. It rewards letting an ambiguous gain remain ambiguous long enough for your edge to play out. Almost nothing else in your life has trained you to do that comfortably. So it makes sense that trading feels like fighting your own wiring, because in this specific way, it is, let me put it in a sentence you can actually hold on to. Your brain isn't afraid of losing money. Your brain is afraid of an uncertain outcome. And a winning trade that hasn't hit its target yet is still technically an uncertain outcome. Right up until you close it, that green number could still turn red, and your nervous system knows that, and it wants the uncertainty resolved far more urgently than it wants the mathematically optimal outcome. If you've made it this far, tell me in the comments. The first time you remember feeling this specifically, not general trading anxiety, but that particular discomfort of being in profit and wanting out. A lot of people can point to an exact trade. Naming it out loud, even just in a comment, tends to be the first moment people stop treating this as some personal weakness and start treating it as a pattern with an actual explanation. Now, let's go deeper into why this specific pattern is so brutal inside a prop firm evaluation, because the structure of an evaluation actually amplifies this exact psychological weak point in a way that trading your own capital doesn't. In a personal account, if you give back some profit, it's frustrating. But there's no external clock, no external gatekeeper, no pass or fail attached to it. In an evaluation, every dollar of profit you're sitting on is also a dollar of distance between you and a very concrete outcome, passing or failing, funded or not funded. This turns your own open profit into something with much higher emotional weight than it would otherwise carry. You're not just protecting money anymore. You're protecting a version of your future that you've already started picturing. The funded account, the scaling plan, maybe even telling people you're close. This is exactly why so many evaluations get lost. Not in the first week when the trader is fresh and calm, but in the final stretch when they're sitting on 7, 8, 9% with a 10% target, close enough to taste it. Watch what happens to trading behavior at that stage. The trader stops taking their normal setups and starts taking safer, smaller, more hesitant positions, or alternatively swings the other way and starts overtrading out of impatience to just get it over with. Both of these are the same root cause wearing different clothes. The profit sitting on the account has become too psychologically loud to think clearly around. Here's something worth sitting with if you're currently mid-evaluation. The version of you that got the account this far, the one who took clean setups without flinching, who let winners run, who didn't touch stop losses out of anxiety. That version of you did not stop existing the moment the account went into strong profit, but it gets quieter. The part of you that's protecting the outcome gets louder, and it starts making decisions instead. If you've ever looked back at a failed evaluation and thought, I was trading so much better 2 weeks ago, this is almost certainly why you didn't lose the skill. You lost access to it because the psychological weight of the profit sitting there took over the decision making. There's a specific version of this worth naming directly. Because if you trade prop firm challenges, you've probably lived it. It's the trade you take near the end of an evaluation that has nothing to do with your strategy and everything to do with wanting the discomfort to end. You're not executing a setup anymore. You're trying to make a feeling stop. Maybe you take a trade too early because waiting for confirmation feels unbearable when you're this close. Maybe you close a good trade at half your normal target because getting to the finish line now feels more urgent than getting there optimally. Neither of these is a strategy failure. Both are the uncomfortable winner pattern, just wearing an evaluation-specific costume. I want to be precise about what I'm not saying here. I'm not saying you should feel nothing when you're close to passing an evaluation. That's not realistic, and it's not the goal. What I'm saying is that the moment you notice your decision-making has shifted from what does my edge say to what makes this feeling go away, that's the signal, not a reason to panic, just a signal. The traders who consistently pass evaluations aren't the ones who feel no pressure near the finish line. They're the ones who've learned to recognize that specific shift the moment it happens instead of 3 trades later when the damage is already done. If you've ever failed an evaluation in the final stretch, closer to passing than you'd ever been, I want you to think back honestly, was it a strategy failure or was it this? Was it a setup that didn't work, or was it a decision that came from wanting the discomfort of being close to end faster than the process actually allows? Most people, when they really look at it, find it was the second one. That's not a comfortable thing to admit, but it's a genuinely useful one because a strategy failure and a psychological failure require completely different fixes, and you can't fix the right one until you've correctly identified which one actually happened. Segment 4, the probabilistic mind applied to winning, roughly minutes 30 to 39. This is a good place to bring in the work of Mark Douglas, because if you've watched other videos on this channel, we come back to his ideas often, and this particular problem sits right at the center of what he spent his career trying to explain. Douglas's core argument was that the market operates as a series of probabilities, not certainties, and that any single trade tells you almost nothing on its own. It's only across a large enough sample of trades executed with consistent rules that an edge actually reveals itself. Most people who've absorbed this idea apply it only to losses. They use it to comfort themselves after a losing trade. This is just one instance in a series. It doesn't mean anything about my edge. Don't overreact to one outcome. That's true. And it's useful, and it's also only half the application. The same logic applies with equal force to a winning trade, and almost nobody uses it that way. A single winning trade also doesn't mean anything on its own. It's just one instance in the same series, which means the anxiety you feel about protecting this particular winner, the urge to lock it in immediately, to not let the market take it back. That urge is built on treating one outcome as uniquely important, exactly the same mental error as overreacting to one loss. If you wouldn't panic sell your entire strategy after one loss because you understand it's just one data point, you also shouldn't panic close a winner early out of fear because it's also just one data point. The trade in front of you right now is not special. It's not the one that has to work out exactly a certain way to validate you. It's one instance in a long series, and your job is to execute your edge the same way regardless of which instance you happen to be sitting in front of. This reframe matters because it removes the emotional weight from any individual trade in both directions. You stop white-knuckling your winners the same way you'd want to stop spiraling over your losers because you're applying the same underlying truth to both. The outcome of this specific trade doesn't define you, doesn't confirm you, doesn't need to be protected out of fear the way you'd protect something rare and irreplaceable. There will be another setup. There will be another winning trade. The current one doesn't have to be rescued from uncertainty before its time because its outcome was never the point. The execution of your edge consistently across the whole series is the point. Douglas also talked about the idea that the market doesn't owe you anything, that it has no memory of your last trade and no obligation to behave a certain way because you need it to. This applies directly here too. The market doesn't know you're up 8% in your evaluation. It doesn't know how close you are to passing. It doesn't know how much this particular winning trade means to you emotionally. It's just price moving according to supply and demand, completely indifferent to your account balance. The moment you start making decisions based on what this trade means to you rather than what price is actually doing, you've left the probabilistic mindset and gone somewhere much more fragile. Here's a practical way to sit with this the next time you're in a winning trade and feel that familiar urge to close it early. Ask yourself one question: am I closing this because my setup is actually invalidated, because price has done something that changes the technical picture, or am I closing this because I want the emotional discomfort of uncertainty to end? Those are two completely different reasons to exit a trade, and only one of them belongs in a trading plan. The other one belongs in this video, being looked at honestly instead of acted on automatically. Rhetorical engagement beat. Pause here for a second and think about your own rules. Do you actually have a defined reason for when you'd exit a winner early written down somewhere? Or is it purely a feeling in the moment? Most traders have detailed rules for their losses: stop loss placement, max daily loss, that kind of thing. And almost no equivalent rules for how they handle a winner psychologically. That asymmetry in your own rulebook is worth noticing, because it's a pretty direct map of where this pattern is most likely to catch you off guard. Segment 5, you have composite trader. One trade full walkthrough, roughly minutes 39 to 48. Let's make this concrete with a single trade, start to finish, because abstract psychology is easy to nod along to and much harder to actually recognize in the moment. I'm going to describe a composite trader, not a real person, but a pattern built from things that show up constantly in this kind of content. And we're going to follow one trade all the way through. She's 3 weeks into a prop firm evaluation. She's up 6%, target is 10. She's been trading well, patient entries. No revenge trading after her 2 losing days, letting winners run more than she used to. This morning, she takes a long on a pullback into a level she's had marked since the day before. Clean entry, tight invalidation below the level, target set at a prior high with a healthy reward relative to her risk. Nothing about this trade is different from 20 other trades she's taken this month. Price moves in her favor almost immediately. Within 4 minutes, she's up a small amount. Within 15 minutes, she's more than halfway to her target. And this is exactly where the pattern we spent the last half hour describing starts to show up. If you know what you're looking for, notice the shift 15 minutes ago. Before entry, she was calm, focused, purely analytical. The moment the trade goes green and starts moving well, her attention changes completely. She's not looking at the chart anymore. Not really. She's looking at the numbers. She starts doing math she wasn't doing before. If I close now, I'd be at 7.2%. That's real progress. That would feel good. Notice that none of this math has anything to do with her strategy. It has to do with the discomfort of watching an unrealized gain that could still technically disappear. She doesn't close it yet, but she moves her stop loss up tighter than her original plan called for, tighter than the actual market structure justifies. She tells herself this is just being sensible, locking in some profit. It's not entirely wrong to protect gains. But notice the reasoning. It wasn't driven by a change in the chart. It was driven by a change in how uncomfortable the open profit felt to sit with. 15 minutes later, a completely normal pullback happens. Price dips, tags her tighten stop, and she's out with barely half of what her original target would have paid her. Price, over the next 20 minutes, goes on to hit her original target and keep running past it. She watches this happen from the sidelines, having already exited. Here's what she tells herself afterward: that was smart risk management. I locked in a win. You can't go broke taking profits. All of that sounds reasonable, and none of it addresses what actually happened. What actually happened is that the trade didn't fail. Her nervous system did the thing nervous systems do with uncertain gains. It wanted the uncertainty resolved immediately, and it found a way to frame that resolution as discipline. This is not a story about a bad trader. This is a story about a good trader having a completely normal, completely human response to holding an uncertain gain and not yet having the tools to notice it happening in real time. The technical skill was never the problem. The entry was clean. The invalidation was sound. The target was reasonable. The only thing that broke was her relationship to the open profit. And that break cost her almost half the value of an otherwise perfectly executed trade. If this story felt uncomfortably familiar, that's the point. This isn't rare. This is, if anything, one of the most common ways a technically sound trader underperforms their own strategy, and it's almost invisible from the outside because every individual decision, tightening the stop, taking the early exit, looks reasonable in isolation. It's only when you zoom out and ask why the decision-making changed the exact moment the trade turned in her favor that the actual pattern becomes visible. I want you to think of your own version of this trade, not a hypothetical one, an actual trade from the last month where you can remember the exact moment, the anxiety, anxiety of being in profit changed how you were managing the position. If one's coming to mind right now, that's not a coincidence. That's the whole reason this video exists. So if this is universal, if this is wired into how the human brain treats uncertain gains, what actually separates traders who manage to hold winners well from traders who don't? It's not that the first group doesn't feel the discomfort. Everyone feels it. It's what they do in the specific moment the discomfort shows up. The traders who handle this well have usually done one specific piece of work in advance before they're ever in the trade. They've decided ahead of time while calm exactly what would justify moving a stop loss or taking an early exit. A real technical reason, not a feeling, and critically, they've decided this before entering, not in the middle of the trade when the anxiety is live and actively trying to rewrite the rules in real time. This matters because the version of you sitting calmly before a trade and the version of you sitting inside an uncomfortable winner are functionally making decisions with different amounts of information and different amounts of emotional noise. The calm version of you is the one who should be setting the rules. The anxious version of you should just be following them. The second thing that separates these traders is a habit of naming the feeling instead of acting on it immediately. This sounds almost too simple to matter, but it changes the entire sequence. Instead of noticing the urge to close early and closing early, the trader notices the urge and then asks the question we covered earlier, is this urge based on the chart or is it based on discomfort? Just inserting that pause, that single question, breaks the automatic link between feeling uncomfortable and acting on the discomfort. You're not trying to eliminate the feeling, you're trying to stop it from making the decision for you. The third thing, and this one takes longer to build, is genuinely internalizing the probabilistic framing we talked about earlier to the point where it's not just an idea you agree with intellectually, but something that actually changes how a single trade feels while you're in it. This doesn't happen from watching one video. It happens from repetition, from noticing this pattern trade after trade, naming it, and slowly, gradually letting any one trade matter less. Because you genuinely believe at a felt level and not just an intellectual one that your results live in the sample size and not in any individual instance. None of this is a checklist you complete once. This is closer to a practice, something you keep returning to, the same way the traders you probably admire keep returning to their own rules. Not because they've transcended the discomfort, but because they've built a working relationship with it. The discomfort doesn't disappear for good traders, it just stops being the one making decisions. Before we close, I want to give you something to actually take into your next session. Not a rule, just a set of questions worth asking yourself. Honestly, the next time you're sitting in a winning trade, has anything about the setup actually changed, or has only the number changed? Am I moving my stop because price structure justifies it or because I want certainty? If this trade were flat right now instead of green, would I still be making this exact decision? And the one that tends to cut deepest, am I trying to protect my edge right now? Or am I trying to protect a feeling? You don't need to answer these perfectly. You don't need to have some breakthrough the first time you ask them. The value is entirely in the asking, in building the habit of pausing at exactly the moment your nervous system wants you to move fastest. That pause, more than any indicator or any rule, is where this particular kind of self-sabotage loses its grip. So here's where I'll leave this. We've spent an hour on the discomfort of winning, on why your brain treats an open gain as a threat, on how this shows up with particular intensity inside a prop firm evaluation, on what Douglas's probabilistic thinking actually looks like when you apply it to your winners and not just your losses. What we haven't covered, and what I think might actually be the harder question, is what happens after you've caught yourself doing this a few times. Once you can see the pattern, once you know the feeling by name, there's a second problem that shows up, which is what to actually replace the old automatic reaction with in the exact second it's happening. When there's no time to think slowly, that's a different kind of skill than recognition, and it's genuinely harder to build. That's where we're going next for now. Just start noticing the next winning trade you're in. Watch what your hand does before your mind catches up to it. That's usually where the real information is.